Andrew Holland, Chief Executive Officer with Ambit Investment Advisors, joins us live from his Mumbai office. Andrew, fantastic to have you back. Thank you for joining us, Andrew. Indian equities are down more than 6% from the recent highs. How much more to go before we hit a durable trading bottom?
In terms of the developed markets, I'm kind of less worried because I think Bernanke's told us that US is going to have reasonable growth, and I think you'll find money going towards US markets at some point. So it's dollar positive, it's probably crude positive as well in terms of prices going higher. I think my concern is not necessarily just India, it's emerging markets globally, and there's lots of problems out there. And India is actually, we look at and think that everything's bad here, but it's the market here has been outperforming, and my concern about that is that funds flow from emerging markets could continue to accelerate, and with India outperforming in the very short term, it could be seen as a market where you actually raise funds. It's not worth going to China where you're down 9% in 2 days, and you're only down 1% in India. You're going to use India as your source of funds, and that's where we could see more FII selling. Not as though they want to sell India, they think it's okay, but you just might be forced to sell your better markets or better performing markets where a lot of funds still have overweight positions.
Andrew, if your view is that in the near term, FI selling will not reduce, in fact it will only intensify, should one avoid quality stocks which are owned by foreigners? Because if foreigners are in a mood to sell, they will only sell what they own, and what they own is financials and good quality consumer and pharma names.
What I think will happen, Nikunj, is that if it's ETF selling, then basically it's broad-based nifty selling which will happen. So it doesn't matter which stock you own, it's going to go down. I mean, some might relatively outperform, but they're all going to go down at the kind of a reasonable kind of pace. So my concern is that, and again, what I want to say here is rather than I'm kind of so negative on India, it's more in what could be happening in other emerging markets. And what the policy response from their central banks will be. We saw Indonesia a few weeks ago raise interest rates. And if there's a policy misstep here, it could be a summer of problems for emerging markets. So maybe emerging markets will overtake Europe this year as being the main concern going into the summer. And really we don't have the kind of balance sheets that, say, Europe and the US have, and Japan to kind of get us through these problems. So that's where my concern comes, and that could lead to further selling on emerging markets, which have a direct impact in India. It might well outperform, but it's really just going to fall in line with other markets. So that's where I'm coming from.
So, Andrew, I mean, have valuations adjusted enough for you, or do you see more pain ahead? And could we be staring at another 5 to 10% downside?
The problem with when you're looking at something which we're not used to, i.e. we're only used to the Fed easing, European easing, and therefore easy monetary conditions. I think we have to take a painful adjustment. And with bond yields rising here, the rupee where it is, there's many problems which I'm hearing in the real estate sector. So after gold falling, maybe the real estate sector is the next one to take a hit, and that's going to have a big impact on the banking sector. And that's where I think the pain for India could come from, in terms of what we're sweeping under the carpet might actually kind of come out from under the carpet, and that would just take us another leg down. So those are the things that could unfold if we continue to see this kind of turmoil in emerging markets, which unfortunately I think will continue.
Andrew, the China data from China has really been quite disastrous. The macro data has been disappointing. Interbank rates have shot up, and there is now a growth projection of just about 6% this year coming in from China. If things were to fall further for China, do you think that could spell disaster when it comes to the rest of the world, and especially emerging markets like ours?
That's the point I'm trying to make, is that it's problems elsewhere. in emerging markets, which will, whether it's China, whether it's Brazil, whether it's Turkey, whether it's Indonesia, the Philippines, something will give, or it is giving already, and that will just have outflows from emerging markets. And when you have the Fed on a footing where they're saying that growth is going to pick up, then obviously dollar assets, dollar stocks are going to be where you want to put your money, and the other trade against that is obviously a weaker yen, so that helps the Japanese markets. And emerging markets, become somewhere that you don't want to be overweight at the moment, and that's why we're seeing so much outflows from emerging markets, not just bonds, but now equities. And I think that might continue. As I said, the summer months might be a particularly difficult time for emerging markets. So India can't, ride against the tide here. The government, as you know, talks a lot. Its action are very slow, and as the months pass on, we just get nearer to the elections, and we know that nothing really can move. So there's a small window of opportunity, but in these kind of markets, who wants that opportunity anyway?
Andrew, but do you think the long dollar trade is getting extremely crowded? Just about everyone is selling emerging market equities, emerging market bonds, they're selling gold, they're getting silver, and all they're buying is US dollar. Do you think it's a matter of time, maybe not weeks, but days, that the trade could reverse? Crowded trades don't last long.
Yeah, I mean, there's obviously that contrarian view that could happen, but as I said, it's really... I think the next few weeks are crucial, Nikunj, and that's why I'm not kind of saying that I'm overly negative on India. It's elsewhere that I worry about. So if there's going to be a policy misstep, it's going to be something which is going to hurt emerging markets. It's going to crop up over the next few weeks, and if we can get through those problems without any kind of real disaster, then obviously we can start looking at the Indian market a little bit more positively. I mean, at these levels, I'm from where we were a month or so ago, I'm feeling more kind of less cautious than I was in May. But because of problems outside of India, I'm just keeping a little bit nervous about the flows to India, or the outflows from India, which are dependent on what happens elsewhere. And that's the problem for India. It's always about what happens elsewhere.
Andrew, whereas I'm with you when it comes to emerging market analysis, but let's look at the Fed communication. The Fed is also of the view that US economy has hit a bottom, and they are of the view that US economy will revive. So soon we could be staring at a situation that a $15 trillion economy, which has not grown for last 1 decade, that could be growing. Is that bad news? Is that, I think this is fantastic news for growth watchers. And if growth is back, equities as an asset class will do well, because growth and equities, they always go in line with each other.
Absolutely, I don't disagree. I mean, that's great news for the world. China's growth is slowing, and the US is taking over. That's good news for all of us. And if Japan in July, through Abe shooting a new bazooka, in terms of what he's going to do with the economy, that will also have a positive impact. And I think Europe seems to be, despite problems in Greece and elsewhere, seems to be muddling through. But in terms of funds flow, and I go back to this because it is important, that's going to find the safe havens of the US and Europe, where dividend yields on some of the top companies are 5-6%. So you've got a lot of safe havens there, apart from emerging markets, which growth is going to stumble along, because China's been a great source of growth for a lot of Asia. And I think we tend to forget that and look to the US. So if the US is picking up, that's great, but if China's slowing, it's going to have an impact on Asian countries and some of the European countries as well. So, it could be a flight to developed markets against emerging markets, and within emerging markets, there might be just a flight away from risk, because there's too much out there at the moment.
So, Andrew, what's the investment approach right now? I mean, what is it that you're telling your clients to do?
Well, from a portfolio approach, we haven't really changed from our kind of defensive stance. I'm still looking for that switch from defensives to interest rate sensitives, infra, capital goods. It's coming, and we're getting closer, but it's not just yet. I don't have that conviction to do so. So, we've been running a a small net short, throughout most of May and into June, and we're continuing to keep that, albeit at a very small level at the moment.
In general, at a time when we could be staring at a tight liquidity regime, should one avoid buying into companies which need more money or more capital to grow, whether it is infrastructure or asset owners or any of the old economy companies?
Well, I think first of all we need to look at the companies who have raised money, and a lot of the companies have raised money offshore in US dollars, and I think that's going to cause them a problem not only in higher interest rates but the forex problems as well. So I think the next quarter results will show us some of the problems that companies have been seeing in a more volatile rupee environment. I think with companies who have still have lots of debt and need to raise money, the share prices have reflected that quite a lot. So probably the equity markets are out of reach for them at the moment, given the valuations. I just would keep with defensive for the time being. I don't need to be too early. I don't mind missing a first market run of 2-3% before having the conviction to moving into the more interest rate sensitive stocks and capital goods. So it's not time yet. It's getting closer though.